How do monumental companies finance their growth, and how can individuals truly own a part of their success? In this video you will learn 1. The definition of a stock. 2. Why companies issue shares. 3. Primary versus secondary markets. 4. How stock prices fluctuate. 5. Risks and rewards of ownership. At its core, a company is an entity structured to generate profit, requiring significant capital for operations, research, development, and expansion. Initial investments from founders or private entities often prove insufficient as ambitions grow, necessitating alternative capital acquisition methods beyond traditional loans. To address this capital demand, companies divide their total ownership into smaller, manageable units. Each unit represents an aliquot proportion of the company's equity. This fractional ownership mechanism allows multiple parties to contribute capital in exchange for a stake. A stock, fundamentally, is a security that represents ownership in a corporation and claims on a portion of the corporation's assets and earnings. It is a certificate, or more commonly, an electronic record, signifying your partial ownership and potential entitlement to future profits and asset value. Companies issue stocks primarily to raise substantial capital without incurring debt obligations. By selling shares to the public, a company can fund ambitious projects, pay off existing debts, or invest in new technologies, essentially leveraging public investment for growth. When a privately held company decides to offer its shares to the general public for the first time, this event is known as an initial public offering, or IPO. This intricate process involves investment banks, regulatory filings, and market valuation to determine the initial share price and quantity. The market for stocks is bifurcated into primary and secondary segments. In the primary market, new stocks are issued and sold by the company directly to investors, typically through an IPO. Conversely, the secondary market is where existing shares are traded among investors, without direct involvement from the issuing company. Stock exchanges, like the New York Stock Exchange or Nasdaq, provide regulated platforms where secondary market transactions occur. These exchanges facilitate the buying and selling of securities, ensuring transparency and efficiency. Individual investors typically access these markets through licensed brokerage firms. Stock prices are determined by a complex interplay of supply and demand, influenced by numerous factors. A company's financial performance, industry trends, economic indicators, geopolitical events, and even market sentiment can cause prices to fluctuate, often dramatically, over short periods. Stocks generally fall into two main categories: common and preferred. Common stock typically grants voting rights at shareholder meetings and offers variable dividends. Preferred stock usually carries no voting rights but offers fixed dividend payments, often taking precedence over common dividends in liquidation. Investors primarily profit from stocks through two mechanisms: dividends and capital gains. Dividends are portions of a company's profits distributed to shareholders. Capital gains arise when an investor sells shares for a price higher than their original purchase price. However, stock ownership carries inherent risks. The market value of stocks can decline due to poor company performance, adverse economic conditions, or broader market downturns, potentially leading to a loss of the original investment. Volatility is an intrinsic characteristic of equity markets. Informed investment decisions often rely on fundamental analysis. This involves evaluating a company's financial statements, management, competitive advantages, and future prospects to determine its intrinsic value. Key metrics include earnings per share, revenue growth, and debt-to-equity ratios. Understanding stocks as fractional ownership in a company clarifies their role in capital formation and individual wealth building. This mechanism enables corporations to scale while providing investors a pathway to participate in economic growth, albeit with associated market risks.